Imagine this: you're a top executive at a company, and you've just realized your stock is massively overvalued by the market. What do? The smartest move? Sell while you can and pocket the gains. But here's the real question: when companies actually raise that money, do they turn around and invest it? The answer might surprise you. According to a study published in the Journal of Asia-Pacific Financial Markets, the more capable the manager, the better they are at timing new stock issuances, flooding the market with shares exactly when prices are inflated. They outperform weaker managers at identifying and exploiting that window of opportunity. They read market trends, they have inside knowledge of their own companies, and they maintain strong relationships with investment banks. Bottom line, they know when the stock price is a fiction, and they act on it fast. But here's where it gets interesting. Where does all that freshly raised cash actually go? The researchers looked at 3 categories of corporate investment: capital expenditures, R&D spending, and acquisitions. And they found that managerial ability had no significant effect on the relationship between overvaluation and subsequent investment. In other words, the money came in, but it didn't go toward building new facilities, funding new research, or growing the business. So what were they doing with it? The study found that highly capable managers were more likely to pursue stock-based acquisitions during periods of overvaluation, essentially trading inflated paper for real assets. On top of that, when stock prices were running hot, more capable managers showed significantly higher levels of insider selling. They were putting their own personal wealth behind that bet. So what does this all mean? It means the entire playbook is designed to benefit existing shareholders, at the expense of the outside investors who bought in at a premium. The research also found that this kind of market timing leaves a lasting imprint on capital structure. This isn't a one-off move, the effects linger. So back to where we started. The best managers spot an overvalued stock, raise a ton of capital, and don't invest it. Who exactly are they serving? The answer is clear: existing shareholders, including themselves. The real pros don't make their mark by spending money, they make it by knowing exactly when to bring it in.